Hello, everyone, and welcome to today's virtual conference on the Economic Outlook for Sub-Saharan Africa. My name is Emily Slater, and I'm the Deputy Director here at the Bretton Woods Committee. I would like to thank our global audience in attendance, especially all of our Bretton Woods Committee members, as well as our esteemed speakers for joining us today. This program is part of our Regional Spotlight series, which aims to evaluate critical economic, development, and trade issues affecting countries and regions across the globe. Today, we will take a look at the economic prospects for Sub-Saharan Africa and discuss implications for both public and private sectors. Before we get started, I would like to go over a few items so you know how to participate in today's virtual conference. We've taken a screenshot of an example of the Attendee Interface. You should see something that looks like this on your own computer desktop in the upper right-hand corner. The orange arrow icon pictured here allows you to collapse and expand the control panel. By default, you have joined the presentation's audio using your computer's speaker system or voice over IP. If you would prefer to join over the telephone, just select telephone in the audio pane and the dial-in information will be displayed. Please note that if you join via telephone, you may not have the ability to pose questions during the Q&A portion at the end of the session. Currently, all participants are in listen-only mode as indicated by the muted icon in the middle of your control panel. During the Q&A portion of the presentation, we will unmute individual lines so participants can pose questions to the speakers. You will also need to ensure that you unmute your microphone from your end as well. The microphone icon on your control panel will turn green when your microphone is enabled. If you have a question, please type your questions into the questions pane of the control panel. You may send in your questions at any time during the virtual conference. We will collect these and call on individuals during the Q&A session at the end of the discussion. You may also use the raise your hand function to gain our attention throughout the presentation. Finally, you may view today's virtual conference in full screen mode by clicking the blue square on the control panel. You can click it again to return to the original viewing preferences. I would now like to introduce our distinguished speakers. We have with us today Mr. Roger Nord, Deputy Director of the Africa Department at the IMF, who will be presenting the findings of their recently released Regional Economic Outlook report for Sub-Saharan Africa. You can find a copy of this report located in the Handouts section on your control panel. In his current role, Mr. Nord has headed missions to Cameroon, Gabon, Tanzania, and Uganda. He was previously Division Chief of the Surveillance Policy Division in what is now the Strategy, Policy, and Review Department, and he was an advisor to former Managing Director Horst Kohler. From 1998 to 2002, he was the IMF's regional representative in Central Europe based in Budapest. We also have with us today Ms. Carolyn Campbell, who is a Bretton Woods Committee member and is Managing Director and Founding Partner at Emerging Capital Partners. With over $2 billion under management, ECP is a leading private equity manager focused exclusively on Africa. ECP has 7 offices across Africa and over 15 years of investing experience, having made over 60 investments and 30 exits with operations in over 40 countries on the continent. Ms. Campbell provides management oversight of the firm's operations and investments. She is also a member of ECP's Executive Committee and of the fund's investment committees. Prior to joining ECP, she was a senior associate at White & Case and an associate professor at George Washington University. Thank you both very much for joining us today. It's a pleasure to have you, and there's no doubt that we have 2 of Africa's regional experts with us today. And so with that, I'd like to turn it over to Mr. Nord to get us started. So Roger, if you would please take it away.
Well, thank you very much. It's a great pleasure for me to be here today. I'm going to give you in hopefully 5 to 10 minutes a flavor of what our latest report on Africa says. After 15 to 20 years of very strong growth in Sub-Saharan Africa, clearly economic prospects have weakened. Our report estimates that in 2015 economic growth reached only 3.5%, and for 2016 we expect it to be at most 3%. But it's a tale of 2 Africas, really. Commodity exporters have been hit very hard, particularly oil exporters. Take Angola, Nigeria, 2 of the largest economies in Sub-Saharan Africa. Growth is unlikely to be much above 2% in 2016. But at the same time, there are other countries, quite a few countries, that continue to enjoy quite robust growth. I'm thinking of Côte d'Ivoire at 8.5% growth, Kenya 6%, Tanzania 7%. So clearly there are really quite different prospects across Africa. So the question is, and this is the central question of our report, is this a rough patch or is it the end of Africa rising? And to give you our answer up front, we think it's the former. It's a rough patch. It's not the end of what has been a success story so far. But of course, there's quite a lot more to it. So let me elaborate a little bit on that by taking a step backwards first and ask the question, what explained the strong growth over the last 15 to 20 years? Commodity prices have been high, but in our analysis, it's the stronger economic policies and stronger institutions that really made a big difference. We did a fairly comprehensive study a year ago looking at the fast-growing countries in Africa and trying to identify what were the factors that really made a big difference. And stronger economic policies and institutions jumped out as the main drivers. You had more financial deepening, where credit to GDP in the fast-growing countries grew by more than 10% over the last 15 years. You had stronger tax bases. Tax to GDP ratios rose by 5 percentage points over that period. And as a result, investment was significantly higher. Investment to GDP ratios, both public and private, rose by over 10%. And at the same time, institutional factors also played a role. Using the World Bank governance database indicators, you could see that the stronger growing countries in Africa performed better on regulatory quality, political stability, control of corruption. So those are the factors that drove the growth over the 15 to 20 years up to 2014. And so the potential to return to growth of 6% or above is definitely there. Now the question that we pose is, what should countries do to achieve that? And I'd like to split that into two. In the short term, there is no doubt that an adjustment to the new reality of low commodity prices, this adjustment is inevitable, particularly, of course, for oil producers. And that means using exchange rate flexibility where available. Fiscal adjustment is clearly going to be needed. But over the medium term, and that is maybe more important if you think about economic growth over the next 15, 20 years, over the medium term, there are really three policy priorities that I'd like to underline. First, there's a need to raise more domestic revenue, to strengthen even further the tax bases in Sub-Saharan Africa. Yes, there's been progress, as I pointed out before, but there's a lot more that can be done. In one of our studies last year, we looked at tax potential, and we estimated that on average there's a tax potential of between 3 and 4 percentage points of GDP across Sub-Saharan Africa. Obviously more in some countries, less in others. And if you think about the oil producers, very dependent on oil revenue, for those, broadening the tax basis to include the non-oil sector is, of course, particularly important. Second policy priority is to strengthen competitiveness. And here I'm thinking of particularly stronger business environments and infrastructure. Infrastructure in Africa remains a key bottleneck. Just one factoid that I like to cite, electricity production per capita in Sub-Saharan Africa remained unchanged between 1985 and 2011. And it is just not imaginable that you can diversify your economy, move into manufacturing without a good, reliable, and affordable electricity production. So infrastructure is a key priority to strengthen competitiveness. And finally, the third policy priority that I'd like to underline is the need to make growth more inclusive. We've seen strong growth in some countries, but we've seen at the same time often a worsening of income distribution. And in a study we did last year, we looked at income and in particular gender inequalities. And in our estimates, if you could reduce those to the levels in, say, South and East Asia, you could gain about 1 percentage point of economic growth per year. So there's a lot of economic potential in what is undoubtedly also a social imperative in many countries. And let me end on a final issue, and that final issue is the demographic dividend. A lot of talk about demographic dividend and the opportunities that this could offer to Africa, and indeed, economic theory as well as experience would suggest that this has huge potential for Sub-Saharan Africa as it goes through its demographic transition, just as Latin America and Asia did earlier in the second half of the 20th century, and Europe in the first half. We did an estimate that if, based on historical patterns, Sub-Saharan Africa's GDP by 2050 could be 24 to 36% higher if you seized fully this demographic dividend. And just one fact to illustrate the potential, based on sort of UN demographic projections, by 2035, not so far from now, more than half of the labor market entrants into the global workforce will come from Sub-Saharan Africa. So the potential is definitely huge. But we also underline that this dividend is definitely not automatic. You need to have the policies in place to reap this dividend. And those policies are both economic, clearly, but also, and I would underline, probably particularly also social policies, education, health. These policies need to be geared towards ensuring that the workforce that I just described, that workforce is indeed capable of seizing the opportunities of integrating into the global economy and becoming the workhorse of the global economy for the next generation. So let me stop there. I'd be happy to answer any questions you may have. Thanks.
Thank you so much for that very comprehensive overview. And I guess I will now just go ahead and turn it over to Carolyn to follow up.
Sure, thanks. And I did read the Imf Regional Outlook release with great interest. First, I'll give you a general background so you get the sort of context from which I will be speaking, the IMF's being rather obvious. We formed an Africa-focused fund management group in 2000. And it was very much focused on the private sector in Africa, which we felt had been quite neglected. We thought the policies were getting into pretty good shape, and that it was time to take what had been happening in the rest of the world in terms of emerging markets growth and apply it in Africa. We have since developed numerous funds and now have a very full cycle track record. We have made 60 investments. We have exited fully from 39 of them, and we have another 5 partially realized investments. So that's a pretty robust fact when you look at the test of a market. Can it deliver returns for investors? The second thing I would say is we have invested over $2 billion on the continent and returned $1.2 billion to our investors. So that's sort of the scope and the framework. At the beginning, we were looking at infrastructure investments. Our mandate was for infrastructure. We then added financial services, which has been coming along, and most recently, consumer businesses, which we define very broadly. It includes education, it includes cafes and this sort of business. In our most recent fund, looking at some of the exciting sectors that we are finding to deliver strong returns and growth, the cellular tower space has been very robust. We invested in a cellular tower company back in 2011. It had 727 cellular towers. That has now grown to nearly 21,000 and counting. So that's in a very short time period. We had a banking platform in West Africa. We invested in sort of the smaller countries initially, so Benin, Chad, Guinea, Togo, and now we've taken that bank and built it out into some of the bigger countries like Ivory Coast and Senegal. We have, as I mentioned, a number of consumer businesses, Java House in Kenya, if anyone has been there, so the cafe chains. We've more than doubled the number of stores there since just 2012, added pizza and yogurt to that offering. And then we do run an electric and water utility in West Africa. We started out in Ivory Coast and Senegal, and now have expanded it into Mali and the Democratic Republic of Congo. So looking at that, our sectoral mandate is quite broad. We are witnessing a lot of economic linkages that are very helpful to our businesses, particularly the banking sector. So you have seen there's a lot more monetary cooperation. We deal very strongly with the WIMU, which is the West African regulator, as well as the central bank for the West African states, and we find dealing with them quite satisfactory. We also, our thesis for how we invest has really evolved over time, mostly to take advantage of the trends that are very strong in Africa. So we focus on domestic-facing opportunities. So you would think that if someone was investing in Africa, we would be looking at the export potential of the world's last bastion of natural resources and arable land. But that has a little added volatility, which we're now seeing more strongly in recent years. So we really focus on basic consumer needs and vital business needs, and it's a very broad domestic-facing mandate. Then we try to create scale in these businesses that have strategic value, and I was giving you some examples of how we build them out. Geographic diversification, we really emphasize diversified regional plays, not just one country sort of investments. And then, of course, what do? We try to secure the ability to drive change, and we're asking a lot of these companies. You know, the infrastructure is not what it is in the developed world, and the understanding of modern business models is not quite what it is in the developed world, and that's really what we go in and try to drive and then take the models and grow them. So, and then the thing I would emphasize is when I read the Imf Regional Outlook, I was very pleased because while it's a bit dismal, if you are an oil exporter or a commodities exporter, it does highlight that there's some pretty significant potential, and it's been sustained potential in countries like Ivory Coast, Kenya, Senegal, and we have a large part of our emphasis has been there. I would like to say we foresaw the commodities crisis, but that really wasn't the case at all. We just always wanted to focus on these domestic-facing factors. I would also say that the growth is widespread, and if you look at a Brookings institution, they yesterday had a seminar on growth in Africa, and a third of the countries have 2 decades of sustained growth. So even the countries in a slump are still performing on a growth trajectory that is very optimistic. Now, with that said, and with our optimism and with our track record, there are some areas where we would like to see a little more development, and that would underpin the growth. And as Roger was saying, you have linkages that are getting stronger in terms of bilateral trade arrangements and trying to make it easier and not tax the same company 4 times in one region. So I would say Southeast Africa is particularly strong on that front and facilitates investments in business operations in that regard. But the hard linkages, so rail and roads and boats and even the telecom linkages, so the terrestrial telecommunications infrastructure. Obviously, I just cited our cellular tower growth. Things like that will be very helpful, but you have a lot more penetration that can happen. And that requires very patient capital because they usually tend to get done, these projects, with project financing. So I think there's a lot of role to be played between the private sector and the public sector in relation to infrastructure in particular, but it does require a little more patience. And I think I will say one more comment on the IMF Outlook report was that the external financing environment is markedly tighter. I did think that is generally true, but there is a lot of cash on investors' balance sheets, particularly in the corporate sector. And if you're looking for high returns with maybe a slightly higher average risk profile, Africa definitely provides that. When you compare the African private equity asset class to what has happened in Eastern Europe and Latin America, it compares very favorably in terms of money return to investors and in terms of year-on-year percentage return on investments. East Asia has been an outlier and probably a little bit above all three of those regions, but there's a lot of doubt cast over Asia. So I think the trends are very encouraging despite the slump, the commodity slump, and I'm very hopeful that countries like Nigeria are now taking a hard look at their non-resources sectors and saying this is what we need to focus on. We have the demographics, the favorable demographics. We've worked really hard on our policies. Nigeria is doing wonders fighting corruption. They have been working on their electricity sector and probably have a little more work to do there. But the fundamentals are very propitious if they want to take advantage and diversify their economies. I think I will leave it there for questions as well.
Great, thank you, Carolyn. I just want to remind our audience that if you do have questions, so please enter them into the questions pane in your control panel. And I guess I will start by asking both of you a question. Talked a lot about the need for increased investment in infrastructure to assist in these enabling business environments. What role can the multilaterals play, the IMF, the World Bank, and also the regional MDBs in helping to leverage those public and private funds that are necessary for investment?
Okay, let me start from the IMF side. Of course, as you know, the IMF itself does not finance projects. What we do is we can help countries create the right environment within which investment, both public and private, can take place. What we've done in recent years is we've looked very closely at debt sustainability issues. Debt sustainability issues are key because investors will come if they have the expectation of having a return, and to put it more bluntly, if they have the expectation to be repaid. So we've invested a lot of time into doing good, deep debt sustainability analysis. And here is where countries in East Africa, such as Tanzania and Kenya and Uganda and Rwanda, benefit from the fact that they have a very low risk of debt distress. So this really encourages countries to come in. A second role for multilaterals is to work on the regulatory environment. In electricity, this is particularly important. Investors have a very long time horizon to be repaid, and they need to have certainty that the regulatory environment allows them indeed to make profits and to be able to repatriate those. And I think Kenya is a good example of a country that put in place a good regulatory environment and is now seeing investment, including in, for example, in geothermal, which requires quite a lot of upfront investment, where you really need a lot of certainty to be able to get your return. But if you do so, geothermal is really an excellent way to go in a country like Kenya. And finally, I should mention that another aspect of the regulatory environment where multilaterals, both the IMF, the World Bank, and others have been helping countries is to put in place a framework that provides a good basis for public-private partnerships, so-called PPPs, often cited as a panacea or as the way to go, but in fact it's not easy to do. You have to do it right. For that you need institutions and regulations that work, that balance the risk between governments and the private sector in a way that ensures both private sector returns, which is what they're looking for, but also protects the government against downside risk and finding themselves in the end holding the bag and ending up with debt problems. So let me stop there. But from an institutional perspective, sort of from an IFI perspective, I think those are three things that we can work on.
Yeah, I would add that I always look at the statistics that in Western Europe after World War II, they invested 8 or 9% of their GDP in infrastructure per year. And China, India have been doing 6 or 7% into their infrastructure. The U.S. does somewhat between 2 and 3%, and Africa it's less than 2. So it needs it more and it gets it less. I think there's a fundamental role for the DFIs on a number of fronts, and we work with them in particular, not necessarily on infrastructure, but in the banking sector. They've been invaluable in terms of helping central banks shape policy. If there's something nonsensical being batted about, or in the electricity sector, we have actually gone to the IMF and had a coffee there and talked it through in details, and they know these sectors inside out and add enormous value. But I would say in structuring bids, first of all, so if you look at the South African program in electricity and energy, it was wonderfully done. Just go on the website and you see the contracts and the transparency and everything. They hired world-class law firms, and that was done with a tremendous attention to detail. In comparison, the Nigerian one was a bit rushed. I think they were meeting with the World Bank the day before the program was launched, and it didn't have the same result, needless to say. The second thing that I think the IMF and the other DFIs can help with is the structuring of products, financial products, which means that not just they can invest the 80 or 90 or $100 billion required in infrastructure in Africa, but the rest of us. So hard currency products, mezzanine products, dividend-paying products or investments, those are all things people are very eager for. I don't know that they require the government, the local government, to put the money in, but maybe to structure a guarantee or structure different levels of the investment would be really important, and that helps de-risk it, that helps give a profile that's within investors' timeframes, and so forth. And then I would say on our electric utility, we worked really closely with the IFC in Ivory Coast, and that's a cogeneration facility adding over 250 megawatts to the country during our little holding period, which is typically 5 to 6 years. It was a huge success. So that was a public-private partnership done with the government, who happens to be a fabulous regulator and has always been very open towards working with the DFIs. In fact, I think the president of the country may have been at the IMF or World Bank or IFC before, but perfect example. So.
Thank you both very much for that response. Certainly the IMF has played a large role in the debt sustainability and the regulatory frameworks. And as we all know, PPPs are kind of a buzzword and a hot topic right now, but certainly offer a lot of potential for the region. We do have some questions from our audience, so I am going to go to our audience now. We have a question from Ms. Jacqueline Irving, so I will unmute your microphone, Jacqueline, and you may pose your question. Jacqueline, are you there? Okay, she is having some issues with her audio, but she has typed in her question, so I will read it for her. Her question is, as Carolyn noted, net oil commodity exporters like Nigeria looking at sectors beyond natural resources is a positive thing. I am surprised that one of the main policy priorities for the medium term in the REO is not the need for net oil and other natural resource exporters to diversify their economies away from reliance on natural resources and towards more value added in agriculture exports.
Well, let me start with that. I think it is indeed a central policy priority. It's more a medium term than a short term priority, frankly, but it's nevertheless a priority. Think about it, and in the short term, you're going to have to deal with the fact that revenue has fallen dramatically. In the case of Angola, to pick an extreme example, but not atypical for a country that is very dependent on oil. Revenue has fallen by more than 20% of GDP. I mean, it's a huge hit to revenue. That adjustment needs to take place, and it needs to take place rapidly if you don't want to see a full-blown balance of payments crisis. Fortunately, Angola has some reserves, or actually, in fact, ample reserves, so it has some time to adjust, but nevertheless, the adjustment is inevitable. But indeed, as the caller says, if you look further ahead, this diversification is absolutely crucial. If you take the case of Nigeria, a little known or often overlooked fact is that the Nigerian economy is much more diversified than you may think. Oil only accounts for 15% of GDP. 85% of GDP is non-oil. However, if you look at government revenue, it's the other way around. 80% of government revenue comes from oil. That imbalance makes the government, and therefore all social services, extremely vulnerable to oil price fluctuations. And when the finance minister of Nigeria was here during the IMF spring meetings, this was what she said was the first priority for Nigeria, which was to make the tax base much more diversified and much more spread across the non-oil sector. We fully agree, and the IMF has quite a lot of expertise in the area of tax policy and administration, and we've been helping Nigeria and others to indeed diversify that tax base, which I think is a step towards the economic diversification that the caller was referring to.
Carolyn, do you
I don't have
comment?
anything to add except that if Roger is speaking to the authorities in Nigeria, the thing that would be most useful is that you do have a wall of money outside of Nigeria, people wanting to invest, but there's a cloud over the currency valuation. And it's, if you look at the difference between the value of the Naira in the parallel market and in the official market, no one's putting their money in because there's a risk of an immediate 50% devaluation. I'm sure there are other factors going into the policymakers' views, but in order to get us to invest and then pay taxes on our investments, that is a huge issue. We have to report all the local taxes we pay to our investors, and they're most eager to see us paying taxes. So that is a fact for Nigeria.
Okay, and we have another question from the audience, which I'm going to read. And we're going back to infrastructure investment and debt sustainability a bit here. The question is from Uthman Mandang, and he asks, the more difficult economic environment for Africa will constrain fiscal sustainability. What will this mean for government support through guarantees or otherwise, in particular for infrastructure investments? And how do IMF programs treat government guarantees in their debt sustainability analysis?
Let me start with the last part of that question. We look at government guarantees in the same way as we would look at debt. It's a conservative, but we think rather prudent approach. So we would look at government and government guaranteed debt together, and that's what we would base our program ceilings on. At the same time, when we do debt sustainability analysis, then we look at the pattern for disbursing debt, not at contracting debt. And so debt sustainability analysis has to make certain assumptions on what would be future debt. And so that's a little bit different from the way an IMF program would set limits on contracting. The good news for Sub-Saharan Africa is that, on average, debt to GDP ratios are still quite low. On average, it's now around 40% or so of GDP. And this compares to levels of 100% or more in many advanced economies. And so that the low levels of debt, which are the result both of the debt relief that was taking place in the 1990s and early 2000s, but also the result of prudent economic policies over the last decade, that gives African countries an opportunity to invest, indeed also not just from the private sector, but also from the public sector. That opportunity should not be squandered. You can only scale up debt once. And so I think it's quite important to ensure that that when infrastructure investments are made and when the public sector is putting money on the table, that's done in a way that yields the most results. And so this goes to public financial management, making sure that project selection and monitoring and financing is all done in a way that protects taxpayers and investors' money. And that's a big focus of many of our programs in Sub-Saharan Africa.
Wonderful, thank you. Carolyn, do you have anything to follow up on that?
Well, I would completely agree, and the debt levels compared to those in the United States here are very impressive, but you do just get one chance. A couple of programs that we have been looking at that appear to be particularly interesting, but they're not in our cornerstone strategy. You look at roads programs in India or even Mozambique, and there you do have the government playing a role in terms of bond issuances, but they're not doing most of it. You get, I think it's Macquarie is a big player in this space out of Australia to help structure it so that you get, as Roger was saying, and as I was saying previously, public-private partnership. So the government does some level, and then there's another role to play for mezzanine debt or something that is has some sort of a return profile on it. At least that's what's been done traditionally. So there are ways to achieve a huge investment in many sectors and pay dividends, or make them attractive to investors as well.
Okay, thank you. And we do have another question. We have a question from Mr. Mahesh Kotecha. And his question is, how do you view the evolving East African community, including the Regional Development Bank, EADB, in terms of its impact on making East Africa an attractive investment destination?
I think we at the IMF were quite optimistic that integration in East Africa is going to be an important part of the economic growth story in that part of the continent in the next 10 to 20 years. But I should start by saying it's not just the IMF that thinks that. The countries themselves have been moving very rapidly in that direction and have indeed set themselves the target of creating a single currency over the next 10 years. What we've been doing with the East African community is working on the common market, on harmonizing regulations, on facilitating cross-border trade. And it's fair to say that the reality on the ground still has some way to go to catch up with the rhetoric. The rhetoric soars higher than what is happening on the ground, but the will is clearly there. But to look at the East African community, as Caroline was saying before, these are the countries that have been growing very rapidly. Uganda, Tanzania, Rwanda, they've all been growing at 6, 7, 8% now for 20 years. That's really an impressive performance. And Kenya, of course, is the traditional powerhouse in that part of Africa. So the potential is huge. The population of the EAC taken all together is coming close to 200 million people. So you can see how from an outside perspective, from an investor perspective, this is a really attractive part of Africa to be in. And the more those countries are integrated and form a single market, the better it is for investors. East African community links up well with our discussion about infrastructure, because some of the fast-growing countries like Uganda and Rwanda are landlocked and depend a lot on transport corridors to the coast. One of the big infrastructure projects currently underway in East Africa is the so-called Standard Gauge Railroad, which is a project where from Mombasa to Nairobi there will be a new rail connection, and that will then later be extended all the way to Kampala in Uganda and then to Kigali in Rwanda. That will be clearly very beneficial for the region, because it will make transport costs, which are currently quite high, will make them far lower. So I think the East African community offers enormous potential. The caller referred to the East African Development Bank. They can certainly play a role, but I think they're today still a small player compared to both the World Bank, the African Development Bank, and the private sector in terms of investments in the East African community. One of the largest investments, apart from the railroad, is in electricity generation. Several very large hydroelectric projects underway on the River Nile in Uganda, totaling $2–3 billion, and that will really change the face of East Africa once those come on stream in the next 5 to 10 years.
Yeah, I would add that in terms of linkages, I'd say 3 things. The first is our emphasis on East Africa was late in our investment strategy. It came after our first 2 funds, and now it's got a large part of our strategy. But one of our first investments, when we made it, we couldn't even put the headquarters in East Africa. We had to move it off to Mauritius, or as I mentioned, we were paying taxes every time a return moved from Tanzania back to Kenya. It was a construction company, or went from Uganda to Rwanda. So we were taxing ourselves out of business. And now I think you can put a headquarters in East Africa. So that's already a great leap forward. Another advantage of East Africa is that it's got proximity, relatively speaking, to Asia. So you are seeing a lot of sovereign investment coming out of Asia. You're seeing a lot of trade linkages and so forth, but particularly in port infrastructure, which then can link up with terrestrial infrastructure in very targeted manners. But that's a large pool of money. The Asian and Middle Eastern sovereign wealth funds are very large, and they are quite commercial, and they're patient. They're not private equity. They're quite patient players in the market. Then the third thing I would mention is that we're finding it increasingly interesting to look not at linkages between countries, but linkages between large cities in Africa. So you're getting the rise of the large cities, similar to what you had in Asia. And it's just as important to look at how there are comparative advantages between one city versus another, or Uganda's a corn producer and Kenya's a wheat importer. There are ways to play on that sort of production and comparative advantage that are very interesting. Similarly, in other sectors, you have people who move between large cities and irrelevant of national borders, and that's something we're watching very closely and looking at infrastructure links there.
Infrastructure certainly seems to be the theme of the conversation. Carolyn, you mentioned earlier East Asia and how it's sort of always held up as this real success story for emerging markets, and other emerging markets and regions are always compared to Eastern Asia. Is that a fair comparison?
Well, I mean, the returns were very high for decades, and they have had their miracles, and the penetration in all their sectors, whether it's insurance or consumer goods, or look at the rise of China and everyone's wearing Chinese clothing and using Chinese products everywhere. It's certainly true. There was a miracle. They did put a lot of money into their infrastructure. Just go to Beijing, or go over to any of the big towers in any of the major Asian cities. Their telecommunications infrastructure, in some senses, could be said to be ahead of ours. But it's not a fair comparison in that they started earlier, and the policies in place between the developed world and Asia were very different than us to Africa for political reasons that were local in Africa. There was a lot of aid. There was some conditionality, but it didn't really work. And there were 54 countries that were not hanging together all that meaningfully. You had the former colonial past. And so the comparison isn't all that fair. I think looking at Latin America is a pretty fair comparison. Eastern Europe got integrated with the EU pretty quickly, so that also makes them a little bit different. But I think, Africa absolutely is on a par with Latin America, and now growth-wise, you look at any region, Africa is poised to grow more strongly than these other regions in the high-growth countries. So I think the other advantage that Africa had over some of the other regions is that the legal systems and the regulatory systems, they may not have been doing their enforcement very well, but they had them. They're either English law trained or French law trained. They have the enforcement bodies. I mean, just take a place like Mauritius now. Their Financial Services Commission has to be one of the top in the world. I mean, probably even tougher than Luxembourg in terms of, transparency, accounting for every penny, source of funds, identity of investors, reporting and financial statements and annual meetings and so forth. So no, the comparison's not fair just because Africa started later, first and foremost.
Roger, would you like to offer any thoughts on that?
I agree with Caroline that the comparison is not entirely fair given the context. I think one success that Asia has achieved, if you look at their growth model, is the integration into global value chains. I mean, that's the way that global manufacturing works nowadays. It's not one country producing one widget, but it's many countries contributing parts to that widget. And this is that integration that I think Africa should strive for over the next 10, 20 years. I completely agree with Caroline that East Africa has a geographical advantage in wanting to integrate into global value chains just because they are on the Asian side of the continent. So I think that is clearly an advantage. Thinking of China, every time I talk to Chinese agencies, they are even more optimistic about Africa than Carolyn and I are. They say that is where the future is. They look at demographics. Chinese have a very long time horizon, so they think 30, 50 years ahead, and they're already planning to have their manufacturing move to Sub-Saharan Africa over the next 30 to 40 years. So I think the comparison at one point in time may not be necessarily ideal, but if you look over the next 10, 20, 30 years, I think Sub-Saharan Africa can indeed learn a lot from the Asian experience and apply it in an African context, which is different, starting even with population density, where of course if you build a toll road from Guangzhou to Shenzhen, that's very easy. For 5 or 10 million people on each end of that road. Think of a toll road from Dar es Salaam to Dodoma, and you're talking about a different type of project. There's just far less economic potential in doing that in a more sparsely populated continent. But that's again where demographics starts to come in. East African community close to 200 million today, but population projections suggest that will double over the next 50 years. And suddenly you're talking about economic spaces that are also going to offer totally different economic returns, more of an Asian scale, if you so will.
Thank you both for your interesting comments on that. I always find it interesting to hear people's response to that comparison. As you mentioned, it's not necessarily fair, but it seems to be the one that's always made. I think we have time for one more question from our audience, so I'll wrap it up with this, and this should be a good ending question. Tatiana Lusinko asks, can you please say a few more words about the outlook for South Africa? What are the spillovers to the rest of the region?
I'll let Roger definitely give his perspective because I would like to hear it as well. But when we started investing in Africa, our investors put a restriction on us, limiting us to 35% of our fund going into South Africa. They really wanted us to take this thesis that we could invest in the pure private sector in Africa and do what's been done everywhere else and run with that, which we did. But they didn't want us going into the developed market, South Africa, and doing what everyone else was doing, which were more leveraged buyouts, U.S. private equity. It has a very robust investment banking sector and a little more developed. So what turns out to have happened is we've put almost nothing into South Africa directly. Yes, we've had a few investments or pieces of a regional investment that are in South Africa, but it hasn't fit this model that I was talking about in terms of domestic-facing, high growth, you know, the high rate of growth of consumer businesses, the penetration story, you know, the under-penetration in so many sectors that you find in the rest of sub-Saharan Africa. That is not to say that we're not looking very hard in South Africa for this sort of an investment. And we have looked, particularly the BEE angle is extremely interesting, but it also has a few barriers to entry. You have to have a BEE partner. We have an office in Johannesburg. It was one of our first offices on the continent. So, I mean, the irony is a bit striking. We're definitely looking, but I think Roger can give us the exact growth statistics for South Africa for 2016, but it isn't where Kenya or Ivory Coast are, and despite their having done their reforms in the electricity sector. We bid on a wind project there, but when there's one bid, there are numerous bids, so it's a pretty competitive market as well, and we don't tend to do competitive auctions. That doesn't fit the strategy that I outlined very well. But I think they're on, you know, they have a lot going for them in terms of their regulatory landscape, their education sectors, and it's a pretty strong country fundamentally. It just doesn't have that exceptional growth going for it right now.
Yes, I think Caroline's right. I mean, South Africa is in a quite a difficult patch right now. I think our growth perspective for 2016 is of growth of barely 0.5%, so 0.5. It's really a very weak growth environment currently for South Africa. There are various reasons for that. I mean, South Africa is, of course, also a commodity producer, so it has been affected by the commodity downturn. So that's one part of it. But they've also had electricity sector challenges that Caroline referred to. They seem to be overcoming them, but it's still one of the constraints. And then South Africa has also aspects of more mature economies. Labor relations can be quite difficult, and so unemployment is quite high in South Africa. So they're clearly facing quite a difficult moment, and economic reforms are needed. In a democracy like South Africa's, that takes consensus building, and I think it's fair to say that they're still in the building phase rather than in the having reached that consensus yet. The caller also asked about regional spillovers or the regional integration of South Africa. And South Africa does play an important part for the region, and South African companies invest in other countries in Sub-Saharan Africa. They know those markets well, so that's been beneficial for others. One of South Africa's direct neighbors, Mozambique, benefited over the last 20 years quite a lot from having a neighbor like South Africa. The port of Mozambique, Maputo, benefits from the fact that South Africa uses it as one of the ports to ship out products or bring in products from the rest of the world. I talked about toll roads. Well, one of the truly effective and economically efficient toll roads is between Maputo and the South African border. That toll road really works well, and you can think, well, why? Because the economics really work. So I think with economic reforms, South Africa can return to being a locomotive for the region, but it still has some challenges to overcome over the next couple of years.
Yes, I'm sure everyone will be paying attention to South Africa in the next few years. And I think, as I said, that's the last question we have from the audience, so we will wrap up there, and that will conclude our virtual conference today. I definitely want to thank our speakers very, very much for joining us today and for your incredibly insightful comments and your really robust dialogue. Really appreciated you joining us and sharing your thoughts with our members. We have recorded today's virtual conference, and it will be posted on our website in the next day or two. And we'll also be sending out an email with the recording. We will also be posting a copy of the IMF report on the website if you did not already download it. So be looking out for those in the next day or two. So once again, I want to thank all of our members and friends in the audience for joining us, and want to once again sincerely thank our speakers for joining us today.
You're most welcome.
Everyone.
Thanks, Emily. Bye, Roger.
Bye, Caroline. Bye, Emily.